My main focus point today is about shareholder yield. What is shareholder yield? Now, some people might call it a total payout. They might call it total yield, but it's very simple. It's the net buyback yield. So how much money these companies are spending on buying back shares plus their dividend yield. Okay. So these are the two primary ways that companies return cash flow to shareholders. Now, many argue that buybacks are less direct, but more tax efficient. And dividends go directly to you, but they are not tax efficient because you pay taxes as the shareholder, especially if it's in a taxable account. And everyone knows about dividends. Everyone focuses on dividends, but it's not the end all be all. I talk about this all the time. It's part of the picture. And for some, it might be more important than others, but it should never, ever, ever be the only part of the picture that you look at. Now, when companies initiate a dividend, it opens them up to more buyers of their shares. So that's why a lot of them will pay some dividend, tends to be a low dividend, and a very comfortable dividend, and the additional cash flow above that dividend payout they use to buy back shares. That's been a common theme of companies, is to keep those dividend yields low. Dividend payouts low. Because you don't want to be the leader of the company that cuts the dividend. It looks bad. It feels bad. And usually the stock falls because just as paying out a dividend suddenly opens you up to more shareholders, more types of investors, getting rid of the dividend and eliminating it completely shuts those investors out and there's forced selling. And then the stock plummets. So let's talk about the pros and cons of both. Now, one drawback of dividends is double taxation, meaning the company will go and they earn money and they pay taxes on profits. And then they go and pay a dividend out of those profits to you, and you pay taxes on those profits as well. That is what we call double taxation. Now, when a company instead takes that cash flow and they buy back shares, there's no tax event there, except for recently there's the 1% buyback tax. Still pretty small, but that was in 2022 when it was implemented. Still small, much less than whatever tax you're going to pay on your dividends if it's in a taxable account. But generally, there's not really tax for buying back shares outside of that 1%. And you get to choose when you take that taxable hit by selling those shares that you own. So it's more controlled from a tax perspective. Now, another aspect of buying back shares that's important is the flexibility. I talked about you don't want to be the leader that cuts the dividend or eliminates the dividend, but you don't have that same stigma when maybe you lower your amount of shares you're buying back. Maybe you eliminate it completely. Say that we're not continuing with our buyback plan. And a lot of times the board will approve a buyback figure, but it's not, you don't have to do it every quarter, right? You don't have to, if shares are too expensive, maybe you don't buy back any shares that quarter. And you wait until you get a better price. So it allows companies to deploy cash more strategically. Maybe your business is doing fine, but sentiment in the equity markets is just bad. And generally people are selling stocks and suddenly your stock is cheap. And now you're able to use your cash flow to go buy back shares, up your amount of buybacks versus upping a dividend. Now, research shows that looking at total yield or shareholder yield actually gives you a better risk-adjusted return over the long term. It's better than quality investing. It's better than investing based on growth. It only lags momentum as a factor premium. And what's interesting here is with all the money that is in high dividend ETFs, there's only about 2.9 billion in about 8 different shareholder yield focused ETFs. There's 8 out there. Now, what's the downside of looking at this? Well, just focusing on dividend or shareholder yield can ignore value or can ignore problems with the business. Right? Just because companies are buying back shares doesn't mean that's the right way to allocate their capital. And so it can still expose you to value traps, just like chasing big dividends can. Then there's turnover. So because the buybacks vary, you may be chasing a company that upped its dividend or upped its buybacks because times were good, but it's a cyclical business and those buybacks could be eliminated. So turnover is a risk here as well. And then concentration, right? When you're focusing on additional checkbox, which is shareholder yield, combining dividend and buybacks, you narrow your opportunity set as well. So it's something definitely to look at, but as usual, it's not the end all be all.